Hello everyone, and welcome back to Orange US Stock Research. Today, we're doing a comprehensive deep dive into one of the most polarizing stocks on the market, Tesla, ticker symbol TSLA. Tesla is currently trading at around $399 per share, giving it a market capitalization of roughly $1.28 trillion. But here's the big question. With a trailing P/E ratio approaching 380 and its first-ever annual revenue decline, is Tesla still a buy? Or has the dream run too far ahead of reality? Let's break it all down with the latest official disclosed data. Tesla Inc. was founded in 2003 and went public in 2010. Headquartered in Austin, Texas, the company designs, develops, manufactures, and sells electric vehicles, energy generation and storage systems, and related services. It operates globally, with major manufacturing facilities in California, Texas, Shanghai, and Berlin. Tesla's business is organized into three main segments. First, the automotive segment, which remains the core revenue driver, generating $69.5 billion in fiscal year 2025. Second, the energy generation and storage segment, which has been growing rapidly and brought in $12.8 billion. And third, services and other, contributing $12.5 billion, which includes vehicle servicing, supercharging revenue, insurance, and parts sales. As of the end of 2025, Tesla has delivered a cumulative 8.9 million vehicles worldwide, operates over 8,100 supercharger stations with nearly 77,700 connectors, and employs approximately 134,800 people. The company has also expanded into AI, robotics, and autonomous driving, positioning itself as what management calls a physical AI company. Let's look at the revenue composition in more detail. In fiscal year 2025, Tesla generated total revenue of $94.8 billion. Automotive remains dominant at 73% of total revenue, but here's the important trend: that share has been declining. Back in 2021, automotive was 88% of revenue. Meanwhile, the energy segment has been the standout performer, growing 27% year-over-year to $12.8 billion. Services and other also grew 19% to $12.5 billion. This diversification is critical because, as we'll see in the next few slides, the automotive business is under significant pressure. The fact that Tesla is building alternative revenue streams in energy and services could prove to be a strategic lifeline. Now this is where things get really interesting and concerning. Looking at the 5-year revenue trend, Tesla experienced explosive growth from 2021 to 2023, with revenue nearly doubling from $53.8 billion to $96.8 billion. But growth essentially stalled in 2024 at $97.7 billion, just a 1% increase. And in 2025, Tesla reported its first-ever annual revenue decline, with total revenue falling 3% to $94.8 billion. The earnings picture is even more dramatic. GAAP net income peaked at $15 billion in 2023, then collapsed to $7.1 billion in 2024, a 53% drop, and fell another 46% to just $3.8 billion in 2025. That means Tesla's net income has declined by roughly 75% from its peak in just 2 years. Diluted earnings per share tell the same story, from a peak of $4.30 in 2023 down to $2.04 in 2024, and just $1.08 in 2025. This is a company whose earnings are moving sharply in the wrong direction, and that's important context when we talk about valuation later. Margins are a critical part of the Tesla story. The operating margin peaked at 16.8% in 2022, a remarkable figure for an automaker, but has since compressed dramatically to just 4.6% in 2025. That's a decline of over 1,200 basis points in 3 years. Automotive gross margin, excluding regulatory credits, has stabilized at 15.4% for both 2024 and 2025, after falling sharply from 27% in 2021. However, there's a silver lining in the quarterly data. Q4 2025 automotive gross margin excluding credits improved to 17.9%, the best quarterly figure in over a year. This suggests that the worst of the margin compression may be behind us. The overall GAAP gross margin for fiscal year 2025 was 18%, essentially flat year-over-year. Operating expenses, however, surged 23% to $12.7 billion, driven by heavy investment in AI research, autonomous driving development, and restructuring charges. This is the primary reason operating income fell 38%, despite relatively stable gross margins. Now let's talk about something genuinely impressive, Tesla's balance sheet. As of December 31, 2025, Tesla holds $44.1 billion in cash equivalents, and investments, a 21% increase year-over-year, and one of the strongest cash positions of any company in the world. Total debt is just $8.2 billion, with a debt-to-equity ratio of only 0.1. The current ratio stands at 2.16, indicating strong liquidity. Free cash flow came in at $6.2 billion, a 74% improvement from 2024. This fortress balance sheet gives Tesla enormous flexibility to fund Cybercab, Tesla Semi, Optimus robots, and AI infrastructure entirely from internal resources, without taking on meaningful debt. Vehicle deliveries are the lifeblood of Tesla's automotive business, and here the trend is troubling. After peaking at 1.81 million deliveries in 2023, volumes declined to 1.79 million in 2024, and fell further to 1.64 million in 2025, a 9% year-over-year decline. This is happening despite Tesla having installed manufacturing capacity of over 2.35 million vehicles per year. That means the company is operating at roughly 70% capacity utilization, a significant underutilization that weighs on fixed cost absorption and margins. The Model 3 and Model Y continue to dominate, accounting for 97% of all deliveries. Other models, including the Cybertruck Model S and Model X, contributed just 50,850 units in 2025, down 40% year-over-year. On the positive side, Tesla completed the refresh of the Model Y lineup in 2025. Active FSD subscriptions grew 38% to 1.1 million, and the company deployed a record 46.7 gigawatt-hours of energy storage, up 49% year-over-year. The energy business is clearly becoming a more important growth engine. Let's assess Tesla's competitive moat. First, vertical integration. Tesla manufactures its own battery cells, power electronics, motors, and AI chips, and operates its own lithium refinery in Texas, the first of its kind in North America. This gives Tesla cost advantages and supply chain resilience that competitors struggle to match. Second, the supercharger network. With over 8,100 stations and 77,700 connectors globally, multiple legacy automakers have adopted Tesla's NACS connector as the industry standard. Third, the AI and data moat. Tesla's fleet collects over 500 years of driving data per day, combined with over 100,000 H100 equivalent GPUs for training. FSD users have driven over 7 billion cumulative miles. However, the moat is narrowing. BYD has surpassed Tesla in global EV sales, and Tesla's U.S. market share has declined from 75% to around 43%. This is where the Tesla bull case gets exciting. Starting with Robotaxi, Tesla began testing driverless rides in Austin in December 2025 and plans to expand to at least 10 cities in the first half of 2026, including Dallas, Phoenix, Miami, and Las Vegas. The Cybercab, Tesla's purpose-built autonomous vehicle, is in tooling with volume production scheduled for the first half of 2026. The Tesla Semi is also entering production in 2026. Then there's Optimus, Tesla's humanoid robot. The Gen 3 version, designed for mass production, will be unveiled in Q1 2026, with production planned before year-end and an eventual target of 1 million robots per year. If Optimus achieves commercial viability, the addressable market could dwarf the automotive business. On the energy side, Megapack 3 production begins at Megafactory Houston in 2026, and Tesla is developing custom AI chips, AI-5 targeting a 50x performance improvement for 2027 and AI-6 for 2028. No analysis is complete without assessing risks. Risk 1, valuation. At a trailing PE of 379, Tesla is priced for perfection. Any disappointment could trigger a sharp correction. Risk 2, declining deliveries. Tesla delivered 9% fewer vehicles in 2025 while running at just 70% of its 2.35 million unit capacity. The demand problem is real. Risk 3, intensifying competition from BYD, Rivian, and legacy automakers. Risk 4, CEO and political risk. Elon Musk's political involvement has measurably impacted brand perception and sales, particularly in Europe. Risk 5. Execution risk on Robotaxi, Cybercab, Optimus, and Semi, all ambitious programs with significant technical and regulatory hurdles. Risk 6. FSD is not yet approved in China or Europe, and tariffs add further uncertainty to the global supply chain. Let's put the valuation in perspective. Tesla's trailing P/E ratio of approximately 379 times earnings is not just high. It's in a completely different universe from traditional automakers, which typically trade at 5 to 10 times earnings. Even compared to the S&P 500 average of around 22 times, Tesla trades at over 17 times the market multiple. The price-to-sales ratio of roughly 13.5 times and EV/EBITDA of approximately 88 times further underscore how much future growth is already baked into the stock price. To justify the current valuation, Tesla would need to grow earnings by roughly 10 to 15 times from current levels, which essentially requires successful execution on Robotaxi, Optimus, and continued energy growth simultaneously. The market is clearly pricing Tesla as a technology and AI company rather than an automaker. Whether that premium is justified depends entirely on your conviction in Tesla's ability to deliver on its ambitious roadmap. Let's bring it all together with our comprehensive scorecard. Financial health scores a 9 out of 10. That $44 billion cash position and minimal debt are truly best in class. Growth potential earns an 8 out of 10, reflecting the extraordinary pipeline of Robotaxi, Optimus, energy storage, and AI initiatives. Competitive moat gets a 7 out of 10, still wide, but narrowing as competition intensifies. Profitability scores just 5 out of 10, reflecting the sharp decline in margins and earnings over the past 2 years. Valuation is our lowest score at 3 out of 10. A P/E near 380 leaves virtually no margin of safety. Management and execution gets a 6 out of 10, acknowledging Elon Musk's visionary leadership, but also the risks associated with his divided attention and controversial public activities. Risk profile scores 5 out of 10, reflecting the numerous execution and market risks we discussed. Our overall score for Tesla is 62 out of 100. So what's our verdict? Our rating for Tesla is hold, or for those without a position, wait. Let us be clear. Tesla is one of the most innovative companies in the world. The long-term potential of Robotaxi, Optimus, and the energy business is genuinely transformative. The balance sheet is a fortress, and the technology pipeline is unmatched. However, the near-term fundamentals are deteriorating. Revenue is declining, margins are compressing, and earnings have fallen 75% from their peak. At a P/E of nearly 380 times, the stock is pricing in flawless execution across multiple moonshot projects, leaving essentially zero margin of safety. For existing shareholders, we'd suggest holding your position and monitoring execution milestones, particularly Robotaxi expansion and Cybercab production ramp in 2026. For potential new investors, we'd recommend waiting for either a more attractive entry point or concrete evidence that the new growth initiatives are translating into revenue and profits. Here's a quick summary of all the key metrics we covered today. Feel free to pause the video and take a screenshot for your reference. And as always, a quick disclaimer. This video is for educational and informational purposes only. It does not constitute financial advice, and we are not licensed financial advisors. All data referenced in this video comes from official disclosed data, including Tesla's quarterly and annual filings. Always do your own research and consult a qualified financial professional before making any investment decisions. If you found this analysis helpful, please like, subscribe, and hit the notification bell so you don't miss our next deep dive. Leave a comment below and let us know, are you bullish or bearish on Tesla? We'd love to hear your thoughts. This is Orange US Stock Research. See you in the next video.